Hey, my name is Benz. How are you? Kamusta? Hola. Kafal how? Thank you for your time and visit. Are you working on an assignment? Preparing for a recitation? Reviewing for an examination? Or advancing a lesson? Learn certain fundamentals of accounting for your school or business. This video about the classifications of accounts and financial statements preparation is right for you. This is part of a series of lessons to help you master the fundamentals of accounting. Ready to focus on our topic? The main objective of this lesson is for you to become very familiar with specific account names, their classification, and what financial statement they belong to. In addition, you will also learn how to prepare financial statements for a service business. You like that? Great. Being familiar with account titles, or account names will help you in recording business transactions effectively, will speed up your ability to prepare financial statements properly, and helps you solve computational problems confidently. On the other hand, having very weak familiarity with account titles will eat up your time in recording and preparing the financial statements. You don't like that, do you? Here are the set of financial statements. First, the income statement or the statement of operating results or financial performance. Don't be confused with the word statement, it simply means a report. The income statement report contains two types or classifications of accounts, namely, revenues and expenses. You heard it right. The income statement contains two types of accounts, the revenues and the expenses. In a while, we shall list down all possible examples of account titles or names under revenues and expenses. So, let's dig into the concept and contents of an income statement. From the final balances of revenue and expense accounts, the first financial statements start with the income statement. Other financial statements are directly and indirectly dependent on its outcome. That is why, it makes sense to say, that financial statements are dependent or related to one another. The standard reporting period for all financial statements is 1 year. While it can be for a month, a quarter, or semi-annual, it cannot be for a period of say, 1 year and 2 months, or 2 years. The longest accounting period should be 1 year. The covered period of measurement is normally very specific to a certain time frame or calendar. An example of this point is, for the month ended, January 31st, or for the quarter ended, March 31st, or the 6-month ended, June 30th, or for the year ended, December 31st. For the period means, for that month only, or for that quarter only, or for that whole year only. Accrual accounting simply means, the income statement must include or report all revenues earned and all expenses used within the period covered, and must exclude those that are not yet. This is what is called in the accounting cycle as year-end adjustments, which is accomplished to make the financial statements complete. The primary objective of the income statement is to compute the net result of operations for the period. On top of that, it guides owners in monitoring profitability, measuring performance, evaluating operations, tracking results, and planning improvements. As stated earlier, the income statement comprises two types or classifications of accounts, namely, revenues and expenses. In the income statement, you should never find any account related to assets or liabilities. The final results of business operations are then forwarded to the statement of changes in owner's equity. It is added to the owner's capital if positive, or income, or deducted, if negative, or loss. To effectively measure business performance every year, all expenses and revenues are closed or reduced to zero at the end of each accounting year. Speaking of accounting year, the normal accounting year is 1 year. It could be a calendar year, which means operation starts in January and ends in December. Or it could be a fiscal year, which means, operations do not start in January but in any other month as long as the 1-year period is complete. Examples include, from February to January, or from March to February, and so on. Computing for net income result is pretty basic. As long as you are well familiar with the expenses and revenue accounts, you will arrive at the correct amount. The income statement for a service business starts by adding the main revenue and other revenues. Then from that total, deduct the total of all operating expenses to get the positive or negative result of doing business. Let us now dig into the classifications of income statement accounts. First, on examples of revenue accounts. Revenue accounts may differ depending on the type of business, but the most common revenue account is called service revenue. Or, to be specific, you may call it dental service income for dental services, or saloon service income for saloon businesses. For professionals rendering services, you may call it consultancy fees income or professional fees income. If the business is in the conduct of rental services, like renting out cars, apartments, or equipment, then you may call the income or revenue account as rental income. And the list goes on depending on the nature of service business. In preparing an income statement, always separate the main source of revenue from other incidental sources. But still get the sum as total revenues. Here's an example of an income statement format containing the main source of revenue and other sources of revenue. Of course, if the business doesn't have other minor sources of revenue, then, you simply do not include it in the income statement. Alright, doing good? By the way, thanks for being a subscriber and helping this channel grow. Salamat. Gracias. Merci. After getting the total revenues or income, our next step is to proceed lining up costs and expenses. Let us identify specific examples of expense accounts that are normal or common among businesses. Let us identify specific examples of business costs or expenses, starting with salaries expense. This is also known as wages expense, which are due to workers or employees. Rent expenses or rental expenses paid for renting commercial spaces, shops, cars, or equipment for the use of business. Next is utilities expense, an expense account used for consumed electricity, water, telephone, and internet connection. Expenses for gasoline and oil may also be included in this account. Transportation expense, on the other hand, is an expense used for transporting employees from one place to another. While delivery expense is an expense account for transporting goods or merchandise to customers. We also have repairs expense or repairs and maintenance expense, an account used for expenditures related to repairs of business assets, such as cars, aircon, furniture, computers, etc. Another is insurance expense for any kind of insurance cost shouldered by the business, such as insurance on buildings, cars, company officers, and so on. Supplies expense is another common expense account. It could be office supplies expense, store supplies expense, shop supplies expense. Supplies are those small items that are purchased in volume and then distributed for use by the business, such as papers, pens, alcohol, containers, wrapping items, takeout bags, and many more. Another account is advertising expense. This represents expenditures for marketing and promotion of company services to different outlets such as digital marketing, billboard advertising, broadcast advertising, and other means of advertising. Certain types of assets are normally used for a long-term period and are required to be depreciated throughout their useful life. An account called depreciation expense will be used. Examples include depreciation expense for office equipment, shop equipment, or store equipment. Or depreciation expense for transportation equipment and depreciation expense for buildings and other assets that are normally used for long-term purposes such as furniture and fixtures. Bad debt expense is next on the list of expenses. Another kind of expense that is connected to the ability of the business to properly collect receivables from clients or customers. But sometimes, when receivables are becoming very difficult to collect, they are instead transferred to bad debt expense. Another term for this account is doubtful account expense. Interest expense, on the other hand, is an expense computed on the amount that is borrowed by the business from banks or other lending companies. These loans are normally, in the form of written promise to pay a certain amount of money in the future, including its interest. Let us keep listing more. Other expense accounts are permit and licenses expense, taxes expense, professional fees expense, representation and entertainment expense. For expenses that are very small in amounts, they can be listed as other expenses or miscellaneous expenses, such as photocopying costs, bank charges, small donations, etc. Hey, we are currently presenting the income statement for a service business. The income statement for a merchandising business and manufacturing business are in separate video lessons. Going back. Folks, these are more or less the expenses that are very common for all service businesses. Let us add some clues or reminders. Sometimes, instead or in lieu of the word expenses, you may encounter terms like used or expired. These terms are the same as expenses. Examples include dental supplies used, office supplies used, prepaid insurance expired, prepaid rent used. In business, when things are used or expired or applied, they are already expenses. Congratulations! We just finished listing down the main classifications of accounts in the income statement. Now, let us complete the income statement format that was presented earlier. To continue on the income statement, simply list down all expenses for the period covered by the report and label them as operating expenses. Get the total expenses and deduct it from the total revenues. If business operation is positive, label the result as operating income or income from operations. From that, deduct income tax, if any, and the result will be net income if positive, or net loss, if negative. Before we leave the income statement, let us identify its different sections. First, the heading. Second, the revenue section. Third, the operating expense section. And fourth, the income or loss section. There you have it. We just completed an income statement for a service business. Awesome. Now let us proceed to the next financial statement. The result of the income statement, which either a net income or a net loss is transferred to the second financial statement, which is the statement of changes in owner's equity. This report contains capital accounts and is the shortest among the financial statements. It communicates the annual growth or sometimes decline in the owner's capital investment. Let us take a look at this report. As recently stated, Statement of Changes in Owner's Equity is the second report that must be prepared after the income statement. It is also reported for a specific period of time, meaning, for the month, for the quarter, or for the year. This report can only be completed once net income or net loss is determined. It communicates how much growth the capital has grown to date. The final objective is to compute the owner's capital at the end of the period. The ending capital is then forwarded to the balance sheet. Computing for ending capital will have the following basic formula. Simply add to the beginning capital the net income result from the income statement and additional investments made by the owner, if any. Then, from the total deduct any withdrawals or drawings made by the owner during the period, including net loss if in case it was a loss instead of income. The result will now be the ending capital. The Statement of Changes in Owner's Equity is a very brief report. It contains the following items. The capital balance at the start of the period. From that, net income is added along with any additional investment during the period. Or if the business incurred a loss, then it is deducted along with any withdrawal of capital, whether that is permanent or temporary. The result is the final owner's capital at the end of the period. To appreciate this more, let us present and illustrate a sample format. Here is the format of the Statement of Changes in Owner's Equity. Again, you start with the heading, followed by the beginning capital. After which you add the net income and additional investment, if any, then from the total deduct any withdrawals or drawings of capital by the owner, if any. Pretty simple and easy, isn't it? Don't be confused. In case the result of operations is a net loss, deduct it. Take a look at this and observe the difference. Did you spot where net loss should be placed? Let me help you. There you go, folks. Let us celebrate for completing the income statement and the Statement of Changes in Owner's Equity. Bravo! Magaling KO. Let us move to the next financial statement, the balance sheet. This is a lengthy one. Are you ready? Let's go. The third financial statement, which is the balance sheet, or statement of financial position and condition, is the third report that must be prepared. It contains the company's resources or assets, company's obligations or liabilities, and the company owner's capital investment. Let us proceed to know the concept, contents, and preparation of this report. Again, the balance sheet is prepared after the statement of changes in owner's equity has been completed. However, unlike the two, which are prepared for a very specific time period, meaning, the amounts are for that month, or for that year only, the balance sheet, on the other hand, reports a continuation of balance from previous period to the current period or as of the moment. Examples are, as of the month ended, January 31st, or as of the quarter ended, March 31st, or as of the year ended, December 31st. The ending capital computed in the statement of changes in owner's equity becomes the balancing link to the balance sheet. The balance sheet communicates how strong or weak the business is. And it helps owners, creditors, investors, and employees learn about the company's financial position or condition, or how healthy and wealthy the company is. The balance sheet also shows financial liquidity or solvency of the company's assets, or how well the company's resources will be able to meet its short- and long-term monetary obligations. One technical aspect of this financial report is its ability to balance. While it looks difficult to some, the balancing mechanics are very simple, basic, and logical. The main objective of this lesson is to introduce you to the different accounts and their classifications. Once you are familiar with where these accounts belong to, balancing will become easy for you. In the next video lessons, we will start introducing the balancing procedures. For now, let's keep learning the accounts and their classifications. Once the balance sheet financial report is completed, its cash account will be the basis of the statement of cash flows. Balancing a balance sheet will be easy once you know which accounts are assets, which ones are liabilities, and which ones are equities or capital. Simply add up all business assets, and the total of that should always equal the total of both liabilities and capital. How is that? Alright, don't panic. Here is the logic. Assets are the entire resources used by the business to generate revenue, pay obligations, and grow its net worth. These business assets are provided by business creditors, as well as provided by business owners. Did you now get the simple logic of why assets should always equal liabilities and capital? Let's bring more points. Business owners are interested in the growth of their invested assets through profits, while creditors are interested in the growth of their invested assets through interest. It makes sense, then, that the composition of assets can also be stated as rightfully, those assets which are owed to creditors are treated as a liability, while those which are owed to owners are treated as equity. More so, liabilities come first because creditors are paid first with their interest before owners get their profit and sometimes loss. Or in cases of bankruptcy, creditors' assets are returned first before owners get whatever is left. Now, therefore, the simple equation and facts stated are the basis upon which the balance sheet report is prepared. Hooray! Are you excited to learn about balance sheet accounts and their classifications? Alright, coming up. First on the balance sheet, contents for a service business are assets accounts. Assets are the entire resources used by a business to generate revenue, pay obligations, and grow its net worth. It is divided into subcategories. Those which are consumable, or convertible into other assets within a very short period, or in less than a year, are called current assets. And those which by nature, are intended to be used, or held for longer than a year, are called long-term assets, or non-current assets. Examples of current asset accounts include cash. This account is where a company's cash transactions are stored. Big companies normally have more cash accounts such as cash in bank for the portion deposited in banks, and those that are in the hands of company cash custodians such as cash on hand and petty cash fund. Trading securities. That is an account for short-term or temporary investment in excess cash. It may also be called investment in trading securities. When business is good and the supply of cash is becoming abundant, it is better to invest it to earn higher returns. Accounts receivable. Customers who want to pay at a later date are placed in this account. Incidentally, when receivables from a customer is becoming very difficult to collect, an allowance for bad debt accounts can be created to reduce accounts receivable by certain amount covering the estimated amount that is uncollectible. Notes receivable. Customers who want to pay at a later date can be asked to literally promise it in writing. The written note normally comes with an interest to be paid by the customer on top of the original amount that is due. Accrued income or accrued receivable. Don't mistake accrued income to be an income account. It is not. In fact, it is an asset account. It is a receivable account. If you include any of these accounts in the income statement, the net income result will be an error. Are you getting the point? The advantage of knowing and learning the account titles, and where they should belong to, is to help you prepare your financial statements properly by not mixing up the accounts. Let us continue on accrued income. Examples of these include accrued rent income or accrued rent receivables, accrued commission income or accrued commission receivable, accrued interest income, or accrued interest receivables. The term accrued means the service is already received by the customer, but the customer has not paid it yet. We will learn more on accruals in the video lesson called Year-End Adjustments or Accounting Adjustments. For now, we need to focus and be familiar with account titles to strengthen our skills. Supplies, or prepaid supplies, or unused supplies, or unexpired supplies. These accounts are used for any kind of supplies purchased in volume for distribution to employees or departments. To be specific and depending on the nature of business, you may call it dental supplies, salon supplies, store supplies, office supplies, shop supplies, showroom supplies, laundry supplies. Prepaid expenses. Don't be confused. A prepaid expense is not an expense account but rather an asset account. Focus on the word prepaid, which means an advance payment of expenses. It is still an asset since it is intended to be used in the future. Examples include prepaid rent expense, prepaid advertising expense, prepaid insurance expense, prepaid interest expense, prepaid commission expense. Alternatively, it can also be called unused or unexpired, like unused rent expense, or unexpired rent expense, or advanced rent expense. Those are more or less the current asset accounts. Now let's shift to the non-current assets or long-term assets, starting with the account land, and then building. The land account does not undergo depreciation. But the building is. That is why we need an account where annual depreciation is stored, called accumulated depreciation for building. Next account is furniture and fixtures, and its partner accumulated depreciation for furniture and fixtures. Examples of furniture and fixtures include table, chairs, shelves, counter, dividers, steel cabinets, cash vault, and many more. Another account is equipment, and its partner accumulated depreciation for equipment. Depending on where the equipment is being used, we can be very specific, like office equipment, store equipment, shop equipment, salon equipment, dental equipment, transportation equipment. Examples of equipment include aircon units, computers, photocopying machines, security cameras, cars, motorcycles, phones, and many more. Are you still picking up? You can always rewind, if you're lost somewhere. Let us jump to the next category of accounts on the balance sheet, which is the liability section. Liabilities are amounts or services owed by the business to its customers, employees, suppliers, or to creditors, government, and other parties from whom the business is obliged to pay certain amount or deliver a service. It is divided into two categories. Those liabilities or obligations which require payment immediately, or at least to be settled within a year. They are called current liabilities. And those which by nature, are intended to be paid or settled for a period longer than a year. They are called non-current liabilities, or long-term liabilities. Examples of current liability accounts include accounts payable. This account is used to contain amounts owed to suppliers. Next is notes payable, or a written promise to pay together with the interest charged by the supplier. Others are rent payable, for rentals not yet paid, taxes payable, for government taxes that are due but not yet paid, Utilities payable, for bills coming from water, electricity, internet, and telephone. Another is interest payable, in cases where the interest due on notes or loans payable are not yet paid. Accrued expenses. Warning: this account is not an expense. Don't include it in the income statement. Examples of this include accrued interest payable or accrued interest expense, accrued rent payable, or accrued rent expense, accrued commission payable or accrued commission expense, accrued utilities payable or accrued utilities expense. Accrued expenses means the service is already received, but the amount is not yet paid. Unearned revenues or unearned income. Warning again: don't be confused with the word income. They are not income accounts, but are current liability accounts because they are not yet earned. Examples include unearned rent income, unearned interest income, unearned commission income, and unearned service income. Other terms for unearned income are deferred income, or pre-collected income. Unearned income means the amount is already collected, but the service is still pending. Those are more or less the lists of current liabilities. Being familiar with them will soften your stress in preparing the financial statements. Now, we move on to non-current liabilities, or those obligations whose payments are expected to be longer than 1 year. The measurement criteria for a liability to become long-term is 1 year from the balance sheet date. Examples of long-term liabilities are: notes payable. If this is payable beyond 1 year, it is a long-term liability. Loans payable. These are normally borrowed money from banks and are usually long-term. Mortgage payable. These are borrowed money from banks that are pledged with a real estate property, or a movable property such as car, as collateral. Bonds payable. These are liabilities arising from the issuance of a certificate of liability by the borrower called bond certificate, which serves as an evidence for the money borrowed. All these long-term liabilities, that we have just listed, bear interest to be paid regularly, until the principal amount is paid or settled. Hooray! One more category and we're done with the different accounts on the balance sheet. Let us conquer the last and final ones, which are the capital or equity accounts. First is the owner's capital account. This is where we store the investments made by the owner into the business. The capital account is also where the net income or net loss is closed or transferred at the end of each accounting period. Next is the owner's drawing account, which is used to account for any assets taken, used, or collected by the owner for entirely personal reasons. There you go, folks. We just finished digging into the various account classifications used by the financial statements. There were only 5 accounts classifications, namely, revenues, expenses, assets, liabilities, and capital. By not mixing them up, or by not confusing yourself where each account belongs to, you will be able to comfortably prepare financial statements quickly, correctly, and conveniently. What a journey we've went through, but it is worth it. Now let us check a sample balance sheet. Would you like that? Let's now load in the ready-made balance sheet for our case entity, New Clark Green Services. By the way, creating balance sheet and the other financial statements from scratch are taken in great length on a separate lesson. Here are the sections of the balance sheet. Of course, it starts with the heading. Then the main asset section, which is divided into 2 subsections, namely, current asset accounts and their total, the non-current asset accounts and their total, and then the final total of current and non-current assets. Assets are arranged according to liquidity formation, or how each is near to becoming cash or how each is readily convertible into cash. The farther away from becoming liquid, which means becoming cash, the farther away it is from the cash account. Now, let's look at the other side of the balance sheet, which is the liability and owner's equity section. The liability section is divided into 2 subsections or classifications, namely, the current liability accounts and their total, the non-current liability accounts and their total, and then the final total of current and long-term liabilities. Liabilities are arranged according to solvency formation, or how each is near to being settled or satisfied through cash payment. The longest away from being immediately settled, the farther away it is positioned. To bring the balance sheet in equality, We then plot the ending capital computed from the statement of changes in the owner's equity. By doing so, the final total of all liabilities and the owner's equity should now exactly equal the total of all assets. The balance sheet you are seeing here is lengthy, but in a while, once we prepare the notes to financial statements, you should notice how brief this report shall become. Wow! Congratulations for getting this far. Let us continue our financial statements and classifications of accounts journey. Our next stop, the fourth statement, which is officially called the Statement of Cash Flows. This is a report which talks solely on the movement of cash. Specifically, it itemizes the various sources and the various uses of cash. Ready for this one? Great. Mogalling. This report is prepared after the balance sheet has been completed, and with the same length of period as the other financial statements, and also for a particular time period, such as, for the month ended, for the quarter ended, or for the year ended. Unlike the income statement prepared under accrual basis reporting, this financial report is under cash basis reporting. The cash movements are arranged into three important activities during the business cycle, such as operating cash movement, cash investing movement, and cash financing movement. The final figure or amount computed by this report should arrive at exactly the same amount of ending cash balance being reported on the balance sheet. In preparing this report, we need the beginning balance of cash account in the balance sheet, and from that add to it all cash sources and deduct from it all cash uses. By doing that, we should arrive at exactly the same cash in the balance sheet prepared at the end of the period. The cash inflows and outflows, however, are to be arranged and plotted into whether it is an operating cash flows, or investing cash flows, or financing cash flows. For operating cash flows, the sources and uses of cash are those coming from the income statement. Examples of cash inflows in particular are cash collections of revenues or income, while cash outflows are those for payment of operating expenses. Other operating cash flows occur on the balance sheet, particularly on current assets and current liabilities. Examples of cash inflows on the current assets are those cash collections on accounts or notes, receivables, and other current receivables, while cash outflows are those payments for prepaid expenses, such as supplies, rentals, and other prepayments. Examples of cash inflows on the current liabilities are those advanced collection of cash for services to be provided in the future or unearned revenues, while cash outflows are those payments for accounts or notes payable and other current liabilities. For investing cash flows, the sources and uses of cash focus on the ones affecting the balance sheet only, specifically, those that are long-term assets, or non-current assets. Examples of cash inflows include cash from sale of equipment or cash from sale of land, while cash outflows include cash payment for building construction or cash payment for furniture. For financing cash flows, the sources and uses of cash are also tied to the balance sheet only, particularly, non-current or long-term liabilities as well as those cash flows due to capital or equity transactions. Examples of cash inflows on long-term liabilities are those receipts of cash from loans granted or approved by banks, while cash outflows on the other hand, include those payments for maturing loans or mortgage payables. Examples of cash inflows from equity transactions are those additional investments made by the owner, while outflows include temporary or permanent cash withdrawals of capital. With all these details in mind, let us jump into providing the exact format of the statement of cash flows and find out how it looks like. Ready? Alright, coming up. Right after the heading, plot the first section of the statement of cash flows, which consists of the cash inflows from operating activities. Then, from the cash inflows, deduct the cash outflows. The difference between inflows and outflows is either net cash flows provided by, or used for, operating activities. Do the same thing in the next section, which is the cash inflows from investing activities. From the cash investing cash inflows, deduct all cash investing cash outflows. The difference is either the net cash flows provided by or used for investing activities. Then proceed to the third section, which is the cash inflows from financing activities, and do the same process again. From financing cash inflows, deduct all the financing cash outflows. The difference is either net cash flows provided by or used for financing activities. Lastly, after computing the final net cash flows from each of the three activities, sum up the net result of the three sections, and label it net increase or net decrease in cash. From the resulting amount, add the cash balance at the beginning of the period, and the result is the cash balance at the end of the period, which, as we were saying, should be the same as the ending balance of cash in the balance sheet. There you have it, we just finished the overview presentation about the four major financial statements. Now we move to the fifth and last one, which is a supporting financial statement called the Notes to Financial Statements. This report is the fifth and last part of the financial statements. It covers a particular period, such as for the month ended, or for the quarter ended, or for the year ended. It is being prepared alongside, or while the other reports are being accomplished. It helps users of financial statements by providing all required disclosures about important information regarding the business. To keep the four major financial statements as brief as possible, the Notes to Financial Statements contain pages of detailed computations, breakdowns or schedules, and paragraphs of written explanations about the accounts and amounts in the major reports. Let us now demonstrate some basic contents of a Notes to Financial Statements by pulling our income statement and balance sheet, and see how we can shorten their presentation by transferring some details to the Notes to Financial Statements. The Notes to Financial Statements start with its heading. Then, one note at a time, the notes are created. For example, in the income statement, the other incidental income consisting of rental income and interest income, these two items can be transferred to the Notes to Financial Statements, and only the final total is brought forward to the income statement. Also, we have three sets of long-term assets, which are subjected to annual depreciation. The computation of depreciation expense for each is shown in the Notes to Financial Statements, and only the total is shown in the income statement. In that manner, we avoid flooding the main financial statements with similar and minor accounts. When users want to check on where the particular note or information is, there is a reference number or note number indicated on the face of the financial statements as a guide pointing the reader where to find the complete information about a particular item. Let us proceed to the other notes, this time on the balance sheet. Starting with receivables, group together all receivables and plot them in the Notes to Financial Statements under the caption, Trade and Other Receivables. Then, on the balance sheet, all these receivables will just be represented by a single line, Trade and Other Receivables. Next are the prepaid expenses. Let us remove the individual accounts and instead plot a single line of prepaid expenses representing all the four prepayments of expenses. For the long-term assets, the summary note caption should be, Property, Plant, and Equipment. Transfer everything to the Notes to Financial Statements and forward the total to the revised balance sheet. Let us do the same for all current liabilities under caption, Trade and Other Payables. By the way, trade means those transactions arising from clients and suppliers of goods and services. Let us now compare the income statement and balance sheet before and after the Notes to Financial Statements have been prepared. And here is the balance sheet. Did you notice the big difference? We transferred most of the details except for the long-term liabilities, which should remain on the face of the balance sheet, because readers would want to quickly see how much of the business assets are financed by long-term liabilities. What an accomplishment, folks! You just finished learning about the entire set of financial statements for a sole proprietorship service business. Wow! Congratulations for that. Keep re-watching to master it. If you need to validate your knowledge and skills in this area, check the description field below for quizzes, cases, and review materials. The lessons that you have just learned is enough to get you high score in your recitation or quiz about financial statements and account titles. If you need more review materials on this topic to validate your knowledge and understanding, join the membership and get review questionnaires related or specific to financial statements. Once a member, you will have access to other questionnaires on various lessons as well. Continue learning. We have lots of free lesson on to help you master the foundation of accounting. Thank you for learning with us and see you in another accounting course lesson. Also check the description filed below for links on online materials, books, exam reviewers, quiz materials, and more. Palam sa inyo. Bye for now.